Welcome to Skytech-Lens. On May 30th, 2025, the Trump administration, frustrated by failed trade talks, imposed a sweeping 50% tariff on all European Union goods. This was no minor tweak. It shattered decades of trade, hitting everything from German cars to Spanish olive oil. Global markets panicked, with European stocks plunging and investors bracing for chaos. The message from Washington was blunt: the old rules were gone. Retaliation was immediate. Allies suspended trade deals and prepared their own tariffs, igniting a trade conflict few wanted. Economists warned of a $2 trillion blow to global trade, threatening jobs and stability worldwide. The US now stood isolated, watching its former partners quietly plan a future without it. Tariffs are essentially taxes placed on goods that cross international borders, specifically on imports coming into a country. When a government imposes a tariff, it's making foreign products more expensive for consumers and businesses at home. The idea is to give an edge to domestic producers by making imported goods less attractive or affordable. By raising the price of foreign goods, tariffs are supposed to encourage people to buy products made locally, boosting domestic industries and, in theory, protecting jobs. It's a strategy that sounds simple: just make imports cost more, and people will buy local. In theory, it's a form of economic patriotism, a way to support your country's workers and businesses by favoring homegrown products over those made abroad. But in reality, tariffs rarely go unanswered. Other countries see them as hostile moves and quickly retaliate with their own tariffs, sparking trade wars that can escalate rapidly. For example, when the US slaps tariffs on European cars, the European Union might respond by targeting iconic American products like bourbon, motorcycles, or even agricultural goods, making it harder for American companies to sell abroad. Suddenly, American exporters find themselves locked out of key markets, losing customers overseas. Meanwhile, families at home start to notice that everyday items, from groceries to electronics, are getting more expensive. With less competition from abroad, domestic producers often take the opportunity to raise their own prices. This can trigger a wave of inflation, as costs rise across the board, and everyone feels the pinch. Tariffs don't just hurt foreign companies, they act as a hidden tax on everyone at home. Consumers pay more, and small businesses struggle to keep up with rising costs. Businesses crave stability and predictability, but tariffs inject uncertainty into the market. Supply chains get disrupted, shipments are delayed, and companies hesitate to invest or expand. Instead of protecting jobs, tariffs often end up destroying them. As companies lose access to global markets, they're forced to cut back, lay off workers, or even shut down entirely. The result? Higher prices for everyone, lost jobs in industries that depend on exports, and an economy that becomes more fragile and less competitive on the world stage. Tariffs are a blunt tool, meant to protect, but more often than not they backfire, leaving the very people they're supposed to help worse off in the end. Europe and Canada didn't just complain, they hit back. They were determined to show that they wouldn't be pushed around by erratic US policies. The EU launched $95 billion in retaliatory tariffs, targeting iconic American products like Harley-Davidson motorcycles and Midwest cheese. These tariffs were carefully chosen to hit American industries that were both symbolically and economically significant. Canada, deeply tied to US supply chains, stood firm with Europe, ending the era of automatic alignment with Washington. Canadian Prime Minister Justin Trudeau made it clear that Canada would not be a passive player in this new global landscape. Retaliation was just the start. Allies began untangling themselves from the unpredictable US market. European and Canadian businesses started looking for more stable trading partners, rerouting their supply chains to minimize reliance on the US. Long-standing trade deals were paused or canceled, and trust built over 70 years evaporated. The diplomatic fallout was immense, with many countries questioning the reliability of the US as a trading partner. European and Canadian leaders sought new, stable partners, making it clear the US was now seen as a disruptor, not a leader. They engaged in numerous summits and meetings to forge new alliances and trade agreements. The world was moving on, building new bridges and leaving America to face the consequences of its isolation. New trade routes and infrastructure projects were initiated to support this shift. Doing business with a country that changes the rules overnight was simply too risky. The uncertainty led to volatile markets and disrupted supply chains, causing frustration among business leaders. This wasn't a temporary spat, it was a fundamental realignment. The global economic order was being reshaped, with new alliances forming and old ones dissolving. Europe and Canada called America's bluff and started building a future without it. They announced new initiatives and celebrated new deals that excluded the US. The US was left on the sidelines, watching its influence wane. The once dominant superpower found itself increasingly isolated on the global stage. The trade war's first major casualty was Boeing. A $43 billion aircraft deal suspended, sending shockwaves through the global aviation industry. The sudden halt in orders left Boeing's production lines eerily quiet, with hundreds of jets grounded and workers facing uncertainty about their futures. European airlines, once eager to expand their fleets, began reconsidering massive orders. Boardrooms filled with tense discussions as executives weighed the risks of relying on American suppliers amid escalating tariffs and political tensions. Tariffs drove up costs and delayed deliveries, creating bottlenecks at ports and airports. Supply chains that once ran smoothly now faced constant disruptions, with parts and finished products stuck in limbo. The impact was crippling for Boeing, while rival Airbus seized the opportunity, ramping up production and capturing new contracts. The balance of power in the skies began to shift. European carriers even eyed China's Comac as a new supplier, exploring alternatives that would have seemed unthinkable just years before. The global aviation market was being reshaped in real time. The challenge to US dominance in aviation was no longer theoretical. It was happening as new players entered the field and old alliances frayed. On the ground, iconic American brands like Harley-Davidson were hit hard. Exports to Europe plunged 30% as retaliatory tariffs made their motorcycles far more expensive for European buyers. The company was forced to consider moving production overseas just to survive, a move that sparked outrage at home and uncertainty for workers. The very policies meant to protect American industry were, in fact, driving business away. American farmers suffered too, as foreign markets closed their doors. They lost $23 billion in EU exports as retaliatory tariffs hit soybeans, corn, and other crops, leaving silos full and futures uncertain. Dairy, pork, and more were caught in the crossfire, with unsold products piling up and prices collapsing. Wisconsin dairy co-ops saw their markets vanish overnight, forcing some to close their doors after generations in business. The projected $2 trillion drop in global trade became real: lost orders, shuttered factories, and devastated communities across the country. The pain of the trade war was swift, spreading from Wall Street to Main Street, as layoffs mounted and uncertainty grew. It was brutal, far-reaching, and ultimately self-inflicted, a cascade of cancellations and losses that reshaped the American economy. As the US built tariff walls, Canada and the EU strengthened CETA, their free trade agreement. CETA eliminated tariffs on 98% of goods, creating a vast, stable market just as the US closed itself off. Trade between Canada and the EU surged, projected to hit €90 billion by 2026. European companies shifted supply chains to Canada, investing in Quebec and Ontario instead of the US-Canadian clean tech exports to the EU soared, boosted by new green energy partnerships. Steel exports from Canada filled the gap left by US producers priced out by tariffs. CETA became a model for modern trade: zero tariffs, shared values, and sustainable growth. Canada seized the moment, stepping out of America's shadow to become a key global partner. The trade war's pain was personal for millions of Americans. Manufacturers faced rising costs and lost markets, forcing layoffs and closures. Harley-Davidson's collapse in Europe rippled through its US suppliers, while Boeing's troubles hit thousands of aerospace jobs. Tariffs, meant to shield industry, became a cage, cutting off access to global markets. Farmers were hit hardest, losing decades-old export relationships overnight. Government subsidies offered little comfort. The damage was done. The promise of a manufacturing revival proved hollow. Tariffs only accelerated job losses and economic decline. As the US turned inward, the world built new alliances. The EU launched 17 new trade negotiations across Africa, Asia, and the Middle East, weaving a global network independent of Washington. Deals with India and others bypassed the US dollar, challenging American dominance. China supported these moves, eager to build a coalition against US unilateralism. The Canada-EU CETA model became the blueprint: shared rules on climate, labor, and digital policy. This new bloc systematically reduced reliance on the US market. America, once the rulemaker, now risked becoming a rule-taker. The world's economic architecture was being rebuilt, without the US at the center. The US found itself excluded from the industries shaping the future: technology and energy. The EU and Canada deepened cooperation, setting new standards for clean energy and digital governance. A joint clean energy summit sidelined American companies, focusing on hydrogen, smart grids, and rare earth supply chains. The EU's massive renewable hydrogen initiative aimed to replace $60 billion in fossil fuel imports, without US involvement. In tech, EU-Canada agreements on AI and data privacy set global norms, forcing US firms to adapt or be left behind. America's focus on tariffs cost it a seat at the table where tomorrow's rules are written. While the US looked backward, its allies built the future, together. The real casualty of the trade war was trust, the foundation of all international partnerships. For decades, the US was seen as reliable. That reputation shattered in 2025. Allies, burned by sudden tariffs and broken deals, stopped investing and started seeking alternatives. New trade networks emerged, designed to de-risk from American unpredictability. Rebuilding trust will take more than repealing tariffs. It demands a renewed commitment to stability and respect. The world learned the value of dependable partners and reorganized accordingly. America's short-term gambit inflicted long-term damage to its prosperity and influence. The question now, can the US regain trust before it's permanently left out? Thanks for watching, and subscribe to the channel for more updates. Thanks.